Okay, everybody. Hi. Thanks for coming into this week's Middle Class Investor. This is Seth Martin, your host. Just tidying up a few settings here. We're looking at the S&P. Actually, we're looking at the SPY right now, but I'm about to switch over to the S&P 500 index. And as you can see, there's a lot of stuff on there. So let me get rid of some of the stuff that's not important. Okay, that is it. Well, as you can see, we had a huge up week. The market was very, very strong. Now, one of the things we know about wave C's, which I think we're in a wave C, is they're very strong. So it's that last little exuberance that draws, the few bulls sitting on the few bears sitting on the sidelines, not wanting to get in. It just is that last kick of emotion that really draws them in. So it's completely expected. Now, one of the things you'll notice is that we did close this gap. There was a gap. We've been talking about it for a while here. There was a gap right back here that we closed. We filled that gap. And so I've talked about that before, that gaps tend to be filled. Now, the interesting thing is, on a daily chart, we still have this gap way back here. So, and I've talked about this for a while now, there's a possibility that somehow this market's going to make a new high, and this gap here will be filled. I think that's a lower probability, and I'll show you why in a minute. But it is still possible. I mean, there's the market. Here's the thing: the market really can do anything. I mean, just because it's done this or that doesn't mean it has to do, the next logical thing. The market has a tendency to get the most number of people, on the wrong side of it. I mean, that's its tendency, and so far it's acting in that way. But if too many bears start cropping up right in this area, then the market could go on to make a new high somewhere up in this area. So you have to be careful. You can't be too confident. There's nothing wrong with being confident. You want to be confident enough to take action, but not so confident that you want to argue with the market. So those are I guess that's the fine line you have to walk. All right. So, we had a big up week. We closed the gap. I'll show you a shorter term chart here in a minute that could indicate that this is coming to an end. But like I said, you gotta look for evidence, take action, and then pick a place where you're wrong. All right. Here's the 13-week Treasury, and as you can see, wait, let me go back. Let me get out of this. Sorry about that. Okay, let me go back to the weekly price data. It's a little easier to look at. All right, so you can see here we're still following this line. We haven't really had any significant correction. I mean, this line is arbitrary. I mean, I just drew it. I don't know when I drew it, somewhere way back here. And you can see we're following it. Now we've breached it a little bit, but again, the line is arbitrary. So, you have to kind of, you can't just look at a hard break of the line and go, oh, that's it. We're done going up. You got to look at this in context somehow. And so, for example, here there was a pretty decent pullback in rates, but then right here we made this high right here is higher than this high, so the trend resumed. So you can't really be too concerned about it. Of course, it took 1, 2, 3, 4, 5, 6 weeks for this to prove out, but had it come down like this, and then bounced, but only bounced to here, let's say, and started going down like this, well, that would be different. I mean, then you could say, well, maybe rates are finished going down for the time being. But I think rates are clearly not finished going down, and you have to continue to anticipate that the Fed is going to continue to raise. All right. Let's look at volatility. Volatilities continue to pull in. We can get the chart to come up here. There we go. So volatilities continue to pull in. Maybe it'll go all the way back to this this line. I'm not sure. Oops. Sorry about that. I'm in trouble. I'm hitting them. That's a 2-button sequence, and I'm hitting them in reverse. All right, so we could see volatility pull back to the line. I don't know. That's usually don't see volatility spike and then pull all the way back to where it was. I mean, that's a little bit unusual, but like I said, anything's possible. So I think this week and next week are going to be telling for the direction of the trend going forward. If we don't, and I'll show you why again. I've got a shorter term chart that outlines some of the wave action, and I just think it's we're at a critical juncture. All right, here's the 10-year Treasury. So back to rates just for a second. So we talked initially about maybe it pulling back to here, and maybe it's not done. That's certainly possible. Certainly the first leg of the pullback is done from here to here, and it looks like maybe the rise might even be over, unless it's going to continue. But this here looks like this could be a B wave, and it's either at or near completion, and then maybe we have a C wave pull back into this area. So we could very well, in fact, that might coincide with the market sell-off. So if we get a sell-off in the S&P and the Dow and those markets, you could very well see a pullback in rates as the bond market rallies. So this is shaping up to be, very very correlated with the market. So I don't know if everybody's getting that, but basically what happens is when you get a sell-off in stocks, money tends to flow into the bond market, into the 10-year Treasury, because like we've talked about here, when you get a sell-off, you don't know how far back it's going to sell off. So these guys can't go to cash per se, because that is too traumatic for the market and can cause radical things to happen. So what they do is they pull some money out of equities and put it in treasuries. Well, that flood of money going to treasuries causes the yields to fall and the bond prices to go up. So if we were to have a sell-off this week, and let's say for the next several weeks in the market, that would coincide well with a pullback in rates into this 2.6 area, or 2.6% on the 10-year. Right now the 10-year is at 2.937, and it rallied a little bit last week, but then pulled back toward the end of the week. So again, a market sell-off would correlate well with a pullback into this area here. That could last several weeks, and I think it could either start this coming week or the following week. All right. We can look at these other countries, but basically they look a lot like our markets, and most of them are weaker though. Germany looks a little weaker, as you can see here. It's not anywhere close to taking out this high, whereas our markets, in some cases, has already done that. Japan. Let me get Japan up. Same thing with Japan. It hasn't come up here yet. Now it might this week or next week go ahead and rally up into this area. And the United Kingdom, I think the United Kingdom looks a little stronger, which is interesting because the whole Brexit thing, they're talking about how that's going to cost the UK, 4 or 5% in GDP, and yet it seems to be the strongest one in the European area. So I just think that's interesting, which is a great point. Whatever these people are talking to you on the news about, on the TV, I mean, you can almost just, certainly at the turns, at these major turns, they're very wrong. But you can almost just do the opposite of whatever they say all the time, because they're just that off a lot. All right, let's see. Let's just go on it over to the regular charts and pull up. Okay, here's the S&P 500. Let's look at oil and gold and all that stuff first. Let's look at oil first. Okay, so here's oil. In the context of this huge ABC, where C may not be complete. Okay, so this could be A down. That was the 2008 crisis. B was kind of the run-up over the whole Obama administration. And then we've started C back in 2014, but it looks like maybe C is not complete. So we might have another low below this 2016 low. So something something around, and if we go back and look, let's see if we can look at a 20-year. We can look at a 20-year. You can kind of see here's the previous bull market beginning right here. So 1, 2, 3, 4, 5, and then A, B, C. So we could see C pull back, to this $15.50 before resuming. But once we had, if this is 1 and this ABC is 2, then 3 is going to be ginormous, and you're probably going to see oil, I don't know, probably once the new bull market resumes, oil's probably not going to slow down until we get to this 350 area. So there's some pain coming, but it's way out in the future. It's possible that that the bull market has already started, and this is a 1. This is kind of the wave 1 in the inside of the third wave that's coming. But as of right now, it still looks fairly overlappish. In other words, a lot of times in corrections, you get a lot of overlapping kind of action. And this still looks like this could be overlapping and corrective in nature. But we'll wait and see. I mean, if it just pulls down to here and then starts to rally and move up, then I think we can say that this is probably the first move off the bottom, and that wave 3 has begun. But as of right now, expecting this to go much lower, which actually coincides with the dollar. I mean, the dollar looks like it has turned and started to rally. I don't have a. Let's see if I can pull the dollar up. The dollar is DXY. Yeah, DXY. Well, I've got the. This is the ETF for the dollar. If it'll come up, it may not come up. Maybe there's something wrong with it. All right, well, let's not continue to wait on that. Let's look at gold. Gold also, we were talking last week about how it's staying above this line, and I'd say as long as gold is above this line, it's probably more bullish than bearish. If it breaks this line, it's probably coming back all the way back down here to 1180. But as long as it stays above this line, I mean, you could see gold get up here into the 1450 area. So you just, who knows? I think the idealistic kind of move is maybe up into this 14, 15 area, and then a pullback, and then another rally all the way up into the 15, 1530, 1540 area, and then it should start resuming its final pullback into this this area around between around 690 to, let's call it 610, somewhere around there. In fact, if gold pulls back into this area, I mean, if you can get it, my position is going to be I'm going to go try to buy as much as I can, because what's coming next is if gold really takes off, that normally means, like it did here, that normally means the dollar is going to suffer, and which just means your purchasing power is going to be just ravaged. So, but we don't know. I don't want to predict. I'm just saying, if this is the first run up in the next bull market, if this is a wave one, then we should get some sort of A, B, C pullback, and it should be into this kind of area right here. And then what we know about, second wave pullback is that 3 is next, and it's going to be a big move, and it's going to last probably for the rest of my life, and I would say for maybe even 40, 50 years. So if you don't want to be poor over that 40, 50 years in terms of what you can buy in goods and services, you might want to buy some gold if it pulls back into this area. All right, enough of that prediction stuff. All right, let's go back. I want to go back to the S&P 500. And I want to show, since the 2009 low back here, we've had this 5-wave move that's progressing. 1, ABC 2, and a flat. 3 with a run up into 2015, pull back into 2016 and 17. And then basically ever since 2016, the 2016 low, we've been in a wave 5. Now, here's the kicker. Okay, here's where the rubber meets the road, so to speak. Depends on how you count it. Okay, so I'm saying this is a 1 up into here, and then you had 2 and 3 and 4. Okay, now 4, this is a pretty shallow pullback, but so was 2. So, there's some people think that this is the 4, and it could be. Okay, I'm not saying it's not. This could be 1, 2, 3, and then 4, and then we're gonna have a 5. But so far, all this action looks very corrective. And let me zoom in. Let me go to the ES, and let me zoom in on about a, let's see, what do we want to look at? Let's look at like a 4-hour chart. Yeah, perfect. So this was the top in January, and then the strong sell-off down in here into mid-February. And then we had, this looks very corrective, right? So we had kind of an A, B, C pullback. And then we had this run down, which could have been 1, but it turns out this is probably an X wave. So what does that mean? That means you have a W, X, and then this is a Y, okay, for C. And then, so really what we want to focus on right now is just this structure since April till now. To me, this looks, again, very corrective. So I'm looking at, an ABC for A, an ABC for B. See, these are 3s. These are not even 5s. If you look at this, if you really zoom in on this right here, there's no way you can even see a 5 there. This is A, B, C. That's a 3-wave move. So as long as you're making 3-wave moves, there's no opportunity for this to be the next wave up. Now, it could be something that I just don't see in there. But just what I'm used to seeing, this looks like a 3-wave move, this looks like a 3-wave move. And then, of course, you have this other 3-wave move, which is A with this consolidation in a B wave, and then C. Now, C is a 5-wave move, okay? But that's very common. The last wave in a correction often is a 5-wave move. So if you look at this, you can clearly see a 1, a 2, a 3. You can see the A, B, C here, and 4. And so we're just waiting on 5. So once you get to 5, not only is this trend over, but the implications are that this is a 5-wave move in a larger ABC, which is in an even larger ABC. Okay, so we're back to, this is all of it. This is all basically a 2 or a 1, 2, 1, 2 on a huge degree 1. Okay, so the implications are that we could literally sell off all the way back. In fact, once you break, I mean, the first move might be down to here, the 2016 low, and then we get a rally, and then the C wave could bring us all the way back to the start of this trend, which goes all the way back to 2009, March of 2009. So we're talking about big, huge moves in the markets. Let me go back to the short term. Let's just look at this last little bit. So this was clearly very overlapping and of a triangle. So you can kind of see the A, B, C, D, E triangle, okay, and then ending in C. And then you can clearly see a 1, 2, 3, 4, and I think 5 here. So we've completed a 5-wave move. We've made a new high above the old, third wave high. But this is still very strong. So maybe, I mean, you have to zoom in even more. Let's zoom in on let's say an hourly chart. I'm not even sure you can see this on an hourly chart. Yeah, we might even have to go to like a 15-minute. So this is some of the stuff I do, when I'm trading. But, if you're dealing with a 401k, maybe you don't want to mess with all this. And I understand that. So you can kind of see a 1, 2, 3. Maybe this is 4. And then you got this 5-wave move that has a 1, a 2, a 3, a 4, a 5, and then another 4. And so you can see they're getting progressively smaller, which is what happens. This last little move, to see it, maybe you got to go to a 3-minute or a 1-minute even. You can clearly see kind of an ABC here, ending in a wave 4, and you hit a rally up. So 1, 2, 3, 4, 5, and then another 4. And see, we're still in. Here's another one, 1, 2, 3, 4, 5, and then this could be another 4. So the market's it's fractaling. It's fractaling out to the very, very last subdivision. So I guess what I'm trying to say is we could easily have the market could open up on Monday and open up, around 2784, 2785, make a new high, and then immediately sell off. Okay, that could actually happen. This very much looks like that could happen. As you go down to these smaller and smaller subdivisions, the market's it's fractaling out the last vestiges of this up move. Okay. And that's the way the market works. That's why when you go back, let's go back over to the weekly. Let's look at a 20-year. That's why when you go back, right in here, right where wave 3 was coming to an end, this is the same kind of thing that's happening. Just the last little bit of the fractaling wave structure was coming to an end, and then it starts to unravel this way. So I think that is what you're seeing here in this last little bit up here, except it's in a strong wave C. It's not ending in a wave 5 like 3 was. So I don't think we have much left of this. I think either this coming week or next week is going to start some pretty serious selling. So just be prepared to make a decision at some point to step to the sidelines. I think that's the prudent thing to do. And but that's about it. That's about all I have for today. We didn't look at the euro. The euro is the euro is selling off, although we were in some sort of rally here. That's probably a 1, 2, 3, and now we're in some sort of 4 or 4's over, and we're going to come back and make a new lower low below this. What day is this? March 28th low. So look for that to happen. Let's put it on daily. Maybe that'd be easier. So we should see a low below this, March 29th low. If 4 is complete. Now maybe the 4 is maybe 4 is not complete. Maybe it's going to come down a little bit and then rally a little higher and then sell off. The US dollar CAD, we've been looking at that a lot. I think the US dollar CAD is a great place to maybe potentially park some money if you're into that. If you're into parking a little bit of money. Let's go to the weekly and you'll see why. We've got this fairly large ABC on here. We got this move off the bottom and it's progressing. I try to, if I were going to buy the US dollar CAD, I try to get it back here at 1.24. There's no guarantee that you're going to get it there, but I think it's worth a try. The British dollar also looks like an ABC, but it might not be. I don't know. It didn't quite do what I was expecting it to do early on back here, so I'm a little bit suspicious of it now. I think the US dollar CAD is maybe a little bit better play. And then of course the Euro US dollar short is a good play. All right. That's it for this week, everybody. Thanks for coming in, and we'll talk to you next week. Bye-bye. Take care.